It was another tough day in the markets, with most markets here in the United States closing lower. However, the Dow Jones basically closed flat. The Dow has actually changed to a weekly bullish posture, whereas all the rest of the indices do remain with a strongly bearish posture. So we're going to talk about those charts. We're going to talk about the Russell 2000 officially down 20% from its highs. We're also going to get into some sector analysis where I'm going to show you that energy continues to lead the pack, and it's really them and them alone. Everybody else falling by the wayside, but oil stocks continuing to roar higher. Also want to feature some charts like the US dollar that appear to be breaking out to the upside. And then I've got a really great trade application example that I want to share with you tonight that'll kind of help you understand things from the perspective of a long-term investor and some of the fundamental characteristics that we're interested in as dividend investors for high-quality merchandise through a put sale. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's January 27th, 2022. First of all, welcome aboard to those of you who might be new. Remember to go over to YouTube, click subscribe on our channel, and make sure you go down below in our description area. Make sure you're signed up for our email distribution list, so that way you can be notified whenever we post these videos. You'll also receive which stocks are giving you overbought and oversold cluster signals at the bottom of those emails. In addition to that, we're heavy users of Twitter. If you're not doing so already, I would encourage you to follow me. My handle is @BrandonVanZ, and we really appreciate those of you that click like and retweet on these Market Outlook related posts. And then last but not least, we do have a presence on Facebook. Feel free to join our group at that web address you see in the logo in front of you. All right, let's go ahead and jump into today's trade activity. I wanted to get started here featuring a chart of the Russell 2000. Most of you are aware that this is the small cap index in the United States. And the reason we're starting off with this as opposed to the S&P 500 today is because something noteworthy happened today, or at least that's what the financial media would have you believe. We did close down by over 20% from our recent highs, the highs that were hit back here in the first week of November or thereabouts. You can see that with today's pullback in the Russell 2000, which was good for about a 2.29% pullback. That was enough. We are where we have now crossed that threshold of being in a quote-unquote bear market, according to the way that the financial media tends to talk about that. So be aware of that. The other thing that we've been kind of waiting for is whether the S&P 500 is going to enter in a so-called correction. Remember, financial media would tend to call a 10% pullback from the highs a correction, and we are nearly there, but not quite. Remember, on an intraday basis, we were actually down 10% from recent highs on Monday, but because we then bounced that particular day, we can now see that we're not quite closing at that level. So while we have closed lower for the last couple of days, including today, the S&P 500 was down 0.54%, we still haven't had a closing price that is 10% lower than a closing high from back here. That was actually just earlier this calendar year. It's kind of hard to believe, but the closing high on the S&P 500 looks like it was January 3rd. So my oh my, what a January it has been. Some of you might have seen my tweet the other day about the first 16 trading days of the year. This is actually the worst in history. I don't know where we stand here a couple of days later, but it just kind of goes to show you that typically Januaries are not difficult. This one happens to be the case, but normally January is a pretty promising month for the stock market, and this year it was just kind of like a light switch happened. We rode this tide of bullishness all the way into the year end, and then just like a light switch right at the crossover into calendar year 2022, bam, just to the downside there. So we're waiting on that, and we'll keep you posted if we do enter into that so-called correction mode in the S&P 500, but right now we just quite can't get there. Remember, tomorrow is Friday. Oftentimes Fridays, if things get a little hairy, sometimes traders don't like carrying their positions over the weekend where there could be continued bad news that flows out while the market isn't open. I'm not sure if that really plays a big role here today. Remember, that oftentimes happens when we have kind of geopolitical political news stories that are happening or global health pandemics or something along those lines. Right now, the concerns seem to be more along the lines of inflationary pressures and what the Fed is going to do. And a lot of times you don't hear that type of information released over the weekend. So I'm not sure if that'll play out tomorrow, but just keep that in the back of your mind just in case you do start to see that more skittish type of trading. And then also, just in case you're curious, we might as well take a look at the NASDAQ composite from this perspective as well. And you can see that the NASDAQ composite is currently down about 17% from its highs. So remember, the S&P 500 has managed to hold up quite a bit better. Those that have been in the crosshairs of the selling here more recently seem to be more on the growth-oriented side of the equation. Speaking of which, we do have good news on that front. Apple did report their earnings, and they are trading up after hours as we speak. So Apple is in the midst of their own 12% pullback here from their highs on January 3rd. No surprise that that Apple and the S&P 500 topped out on the exact same day, because remember, Apple is the most important member of the S&P 500 since it is a market cap weighted index. And you can see here that we are down about 12.5% as of today's close on Apple, closed close. But here you can see it's kind of probably hard for you to see this, but I'll just read it to you, that the bid after hours is at 167. So we closed at 159. In other words, we're trading up about $8 per share after hours at this moment in time on Apple's earnings release, which is a promising sign there. Remember, there are other stocks like Tesla that reported here within the last 24 hours that have been just getting smoked. And Tesla, as you can see, is in the midst of their own 30% move lower from the beginning of the year. Today was just a terrible day for Tesla, down about 11% there. And it kind of plays into that theme that we've been talking about for weeks, if not months, which is we have a lot of those Cathie Wood style stocks that are just getting crushed. And of course, she made her name off of Tesla, and kudos to her for having the guts to be as bullish on Tesla over the years as she has been, while a lot of other people have been skeptical. But you are seeing the other side of that trade now kind of unwinding, and Tesla's actually held up better than a lot of other companies that the ARK funds have invested in, but even it is getting caught up in that massive rollover of those ARK funds here more recently. Real quick, I guess I should show the Dow Jones as well. Let's just use DIA as our proxy there. And just a reminder, this is one other way for us to kind of grasp who the so-called winners are and who the so-called losers are. We've been having that conversation mostly from the context of the foregrid that I tend to share with you with the market forecast technical indicator. But this is another way to kind of grasp that, where I've been mentioning that the Dow Jones Industrial Average is our relative leader right now. I use relative in air quotes there, or I should say leader in air quotes, because it's hard to call this chart a leading chart, but you can see that by being down only 7%, it is outperforming even the S&P 500, which is down about 10%. So the Dow has been able to kind of hang in there a little bit better due to its focus on big blue chip, oftentimes dividend growth stocks. In fact, we had a long conversation about that very topic here today in my question and answer session. So Dow is kind of holding up better than the rest, but Russell 2000 officially entering into that 20% down move, and NASDAQ Composite not too far behind. NASDAQ Composite, if it were to fall, let's say 3% tomorrow, let's hope that doesn't happen, especially knowing that Apple is supportive of tech stocks at this moment in time. But if it were to happen, then the NASDAQ would be right there coming in next. All right, let's go ahead and take a look here now at our traditional foregrid. And so that is chart 4B for those of you that are following along at home. And you can see that we did have something new to report today. You know, I was referencing there a second ago how the Dow has been the relative leader. And here's yet another piece of evidence to support that notion, which is the Dow actually went back to a weekly bullish posture today, believe it or not. You can see that the Dow was down today, but just barely. It was only down 0.02%. So call it flat, but it was enough kind of holding the line and being well off the lows from Monday's lows, where you were able to turn that green line around. Notice that activity down below where that green line had fallen out of that upper reversal zone. And notice when that happened way back here on January 10th. So that would have been the day on the Dow, which again is the leader, but even the leader, we went bearish as far as our posture on that day. And that green line continued to fall, continued to fall, continued to fall, eventually found itself in the lower reversal zone. And just like I mentioned on Tuesday, where I told you that the Dow would be the one that is most likely to go back to a bullish posture first. Well, here we are 2 days later, and that's exactly what's happening. Noticing that green intermediate line on the market forecast has managed to find its way out of that lower reversal zone. Remember, on the market forecast technical indicator, that lower reversal zone is 20. So you can see here in the label that the intermediate green line is at 23 right now. So because it's above 20 and rising, we now go back to a weekly bullish posture. If it were to continue rising, let's say into next week, and rise above the 50th percentile, we'd then move to a strongly bullish posture. So baby steps, we're not there yet. We still got some work to do, but at least there's just a little ray of sunshine there in one of these indices. So that is something new to report. Dow back to a weekly bullish posture. Unfortunately, with all of the other charts, we are still with the strongly bearish postures. The other thing that I would point out is that today was another volatile day from high to low. Notice that our labels up at the top of all four of those charts where it talks about the daily range is in orange. Remember, if the daily range from high to low is larger than the average true range of recent trading, then that label will be orange. If it is lower than that, then it will be blue. So it's another way to show you that today was a volatile day. It might not have felt like it at the end if you weren't paying attention, right? If you just opened up a copy of the Wall Street Journal tomorrow and saw that the Dow was down 0.02%, you might have thought, oh, pretty boring day. Actually, we had some pretty aggressive trading once again, and that has been par for the course this week, right? We've had some really wide ranges from top to bottom, some long lower shadows in the first part of the week. Today, unfortunately, we had a long upper shadow. Remember, that's kind of the opposite mindset, where you don't necessarily prefer to see that if you want to be bullish on the markets, because it's basically telling you that the bulls were more aggressive earlier in the day, but by the end of the day, the bears sold you off, and you closed kind of in the lower half of the range there. So not the best looking candle for any of these indices today, as we did have some late selling pressure. But from an intermediate posture perspective, at least we've got that weekly bullish posture. So let's talk about the S&P 500 now. You can see it was down 0.54% today. No surprise, it remains strongly bearish. Remember, it has been strongly bearish for quite some time now. Notice that it is still trading below its falling 30-day moving average, as is the case for all four of these charts right now. Notice that the NASDAQ composite was down 1.4%. So it was a pretty aggressive day. This is actually the worst closing day that the NASDAQ has had in several months, right? It touched a little bit lower on an intraday basis on Monday before that epic rally back higher. So it didn't close all that low on Monday, but it did close low today. In fact, it closed near the lows of its session. Again, not a great sign. Now, after hours with the Apple news, that's going to go a long ways. Apple is very, very important. Is it important enough to turn around the entire market? I think it is for a day. I don't think it's necessarily going to be strong enough to send us back into an uptrend, but at least you can kind of hope that tomorrow will start off with maybe a more positive tone. Whereas there kind of felt like there was more of a crescendoing effect happening here. I think tomorrow you're going to have some stabilization, at least in the early hour sessions. We'll see what the afternoon brings. But again, tough day for the NASDAQ, down over 1% there. And the Russell 2000 was the worst performer. In fact, notice what showed up here on the Russell 2000 chart. Not only is it down 20% from its highs, like I showed you a little bit ago on that other chart, but you can also see that's a one-year low that we plotted here today as well, with this pink label showing up here all of a sudden. You are not seeing those on these other charts. Remember that the other charts look quite a bit different, right? The S&P 500, as I mentioned before, actually just hit an all-time high on, in this case, on an intraday basis on January 4th. The Russell doesn't look that way, right? The Russell has been struggling, since November, similar to the NASDAQ, and the Russell has given up so much here. We're actually at 1-year lows. Remember, these charts that I traditionally show you here are 3-month charts, but if I were to change the date here and change it to a 1-year daily instead, you can see exactly why that label is showing up with today's move lower on the Russell, which is a 2.29% move lower, closing near the lows of the session. That's obviously the low of the entire year. The Russell 2000 had been quite flat for most of 2021. That was not the case for the other indices that had been grinding higher. So the Russell 2000 had been the laggard for most of 2021. More recently, the NASDAQ has underperformed them to the downside, but the NASDAQ crushed the Russell 2000 to the upside last year. So there's been kind of an uneasy feeling with the Russell 2000 going on for quite a long time now, as even last year was not a great year for it. I do feel bad for anybody who might have gotten caught up in this head fake here, because this actually looked like a pretty substantial breakout right over here in November for the Russell 2000 as you were getting up and over some of those prior resistance area, and I have a feeling that a lot of people got caught up in that, and if they're still holding till today, they're feeling some extreme pain. Now, if they were getting in on a breakout, they're also the types of people that probably would have gotten out sooner rather than later as well, but it is interesting to see how that shook out with that type of a head fake that violently, right? Because it happened in a very short amount of time, with the breakout to the upside to new highs in November, and then here we are talking about 1-year lows 2 months later. Usually you don't see markets kind of acting that violently there. Let's take a look at our 3 green arrow status here as well. And so our 3 green arrows chart is going to be 4D for those of you that are premium members following along at home. And as you can see, we remain in 3 red arrow status across the board. I was curious how the Dow would be handling things, and you can see that the Dow stands a very good chance tomorrow of plotting a green arrow on the stochastic. Right now, we're not quite there. We're at 24.74. Remember, on the stochastics, the lower reversal zone is a little bit different than the market forecast. On the stochastic, the lower reversal zone is 25. So we're at 24.74 right now. In other words, just a skosh below it. And so if there's just a hint of bullishness in the Dow Jones Industrial Average tomorrow, good chance that we do get one of those green arrows back there. But the other chart's got a little bit more work to do. It does appear, by the way, it should be blindingly obvious for those of you that look at these charts enough that the stochastics are going to be the ones most likely to turn to a green arrow first. I got a question somewhat around this concept in my question and answer session today, although it was a little bit different based on my 5 green arrows that I use for my trend trading class on Mondays. But for those of you that were curious, be aware that all of our stochastics are most likely on these 4 charts to go to a green arrow before the MACD histogram does. Notice how far below the 0 line the MACD histogram is on all 4 of these charts, and look how far below the 30-day moving average each of these candles is. So for me, it's clear as day that when we start getting green arrows, it will be the stochastics that go to the green arrow philosophy there first. But right now, we're still in the penalty box, 3 red arrows across the board. Let's step away and take a look at what's going on over on the internet. I always like to say thank you to those of you that help support these market outlook videos. And just like has been the case all of 2022 thus far, you guys have done a fantastic job for me, and I appreciate that. 113 of you clicked like for me the last time around. Remember, you can do that either directly on Twitter here. As you can see, we pin it to the top of our timeline, both David and I do. Or you can click like directly there on our website. where we have the little Twitter widget underneath the video that you're watching. For those of you that watch directly on YouTube, you can go down below in our description area and you will see the Twitter link in question there. And then there's also a link that's an icon for Twitter on the email that we send out to all of you as well that you can click on that will take you to the tweet in question. So there's 4 different ways that we try to make it as easy as possible for you guys to click like, and it should only take about 5 seconds out of your day. If you're willing to support the efforts that go into these videos and you want to hear from David and I regularly, that's the one thing that we ask you to do, and many of you are willing to give us your 5 seconds in return for our 3+ hours that go into all of the research, the prep, the editing, the uploading, the writing of the paragraph, the sending out of the emails, the notifications, and this, that, and the other thing. There's a whole bunch that goes into it, and we do this all free. So if you appreciate the effort, click like for us there on Twitter. Keep up the great job with that. Specifically, let's see who was out there helping me along this time. And Phil was helping me, and John was helping me, and Valerie, and Vishal, and Ron, and Dennis, and Jim, and Sonia, and Adrian, and Brandon, and Mary, and Fun Jonesy, and Elton, Bob, and Evan, Gerald, Michael, Kirk, Kevin, Jayesh, Paul, Jeanette, Margie, Rick, Aaron. There's my sister-in-law, so I'm getting some shout-outs from the family there. Hello to all of you in Omaha. And also Sheila, and Ian, and Kenneth, and Ray, and Hank, and Walt, and Irene, and et cetera, et cetera. Tons of you here. Too many to roll off. But the point is, I see you. I recognize you. I appreciate that. Every time you guys click like, I see a little notification over here, so I know who's doing it and who's not, and I appreciate each one of you taking that 5 seconds out of your day. Keep it up. All right. Also, wanted to make sure that you were aware that we taught our traditional classes today. So David on Thursday teaches his portfolio management with ETFs class, where he kind of reads the macro conditions to try to put together a long-term portfolio of purely ETFs based upon what he is expecting out of the Fed, out of the US dollar, out of interest rates, and being able to manage a portfolio off of his philosophy. And he does a wonderful job of it. On Thursdays, I teach my question and answer class, which is kind of one of those ask me anything types of styles of classes. And today we were in class for about 3 hours and 45 minutes. Eventually, I got to give way on my WebEx platform so that David can teach his class, which is good because you can imagine after 3 hours and 45 minutes, my voice starts to give out and I'm about ready to get up and stretch and stuff like that as well. But we had some fantastic discussions today. So if you are a premium member, here are some of the things we talked about in case you didn't get to join live. Remember, we do timestamp these questions so that way you can fast forward directly to them. But we talked about NXST as a dividend growth investment candidate. We talked about Huntington Bank as a dividend growth investment candidate. We talked about a general philosophy of growth stocks through bearish market conditions and what our expectations should be. Talked about risk management for a big chunk of that conversation. We also had a conversation about rolling options and how to think about that in terms of what to look out for, talking about credits versus debits, and talking about benefiting your eventual cost basis. We also had a conversation about Cardinal Health as a dividend growth investing candidate. We had a question about how to utilize the option trade grid volume. We had a question about Energy Transfer as a dividend growth investment candidate, and then a conversation about 5 green arrows. So lots of great stuff coming there as well. Also, real quick here on the factor selector, remember I post this on Tuesdays, so it's a couple days stale, but worth mentioning nonetheless, especially because we have a change up at the top. You can see that now dividend yield is the leading factor in this market. And again, if you've been following me in my classes or in this market outlook video in recent weeks, that should not come as a surprise. Remember, dividend stocks have held up reasonably well. And just even from the general index perspective, the Dow Jones Industrial Average has held up reasonably well. So remember, most of the Dow stocks are dividend yielding types of companies. And so that is more of a function of the market having nervousness and trying to hunker down in where it perceives safety, as opposed to a big plug for dividend yield investing in general. Now, as you guys know, I'm a huge dividend investor myself, so it's not that I don't want to display all of that positive energy there, but I'll be the first to tell you that the reason dividend yield is doing well is not just because dividends are all of a sudden going to light the world on fire. It's simply because they're benefiting from everybody else's fear at this moment in time. And then you can see that momentum continues to be dead last. This is our 5th straight week with momentum dead last. That's important to note as well. Remember, momentum of these factors is going to be one of the most speculative factors. It's a way for us to judge risk appetite, and you don't need me to tell you the risk appetite here recently has not been overly kind to those who want to be on the long side of the market. All right, let's go ahead and pop back on over here to the paper money platform. And speaking of volatility, I should also point out real quick the VIX. So let me do this. I'm going to pull up a 10-year weekly chart because this actually came up in my question and answer session today as well. Sometimes we get so caught up in the day-to-day movements that we don't take a step back and kind of see where we're positioned from a longer-term perspective. And I always like to remind folks that when you're the seller of options premium, and we'll talk about this a little bit later with our trade application example here as well, but when you're the seller of options premium, you have an opportunity to sell when market conditions are ripe for selling. And typically the way that I think about it is I like to sell premium when volatility is high. Now, it does also have you assuming additional risk. Remember, oftentimes volatility is high for a reason. So there is certainly a little bit of tug of war that goes back and forth there, where you've got to do your best to manage and balance your risk. But one of the things we talked about in my class today was just simply to identify those bars on this 10-year chart on the VIX where somebody would want to be either a seller of puts or a buyer of stocks in general. And no surprise, a lot of those are prominent areas that you'll remember throughout history. So here's a good example back here where the VIX spiked up to about 30, similar to where we're at right now. So note that the VIX was down just a touch today, but we're still above 30, which is on the higher end of our historical standards here. But back here in October of 2014 would have been a great time to be either buying stocks or selling puts. Here was another violent move in the VIX. Now, this one was near and dear to my heart because that was back when I was still working with invest tools from TD Ameritrade, and I was teaching a dividend class back then when we got filled on stocks like Texas Instruments and John Deere and Automatic Data Processing on this day when everybody else was puking up their shares. That was that flash crash, or I should say mini flash crash day back in August of 2015. Look at what happened to the VIX that day. It went all the way up to 50. Those are great days to be selling puts. Here's another one. This is in February of 2018, and the VIX went tremendously higher and broke out to the upside for just a brief amount of time. If you were a put seller during that week, you would have been thankful for that just a few weeks later. And then, of course, we also know about the Christmas time period here in 2018. Remember, that was a particularly strange holiday period. Usually the holidays are rosy when it comes to the stock market, but in this case, you had a rug pull event that took place on Christmas Eve of 2018. Same thing, the VIX spiked above 30 that particular week, and it would have been a fantastic time to be selling puts or buying stocks. And then, of course, this one stands out like a sore thumb because this was the COVID-19 fallout, right? This was March of 2020. I went through a real money example with my students here in that class today when we were talking about this of a sold put trade that I did that I about fell out of my chair that I couldn't believe was available to me at that time. And the reason for it is because people had lost their mind and the VIX had just erupted. Remember, in the pricing of options, there are three different components: price, time, and volatility. The VIX is effectively your way to figure out what the volatility component is doing. And if the VIX is spiking, all else being equal, your options contracts are getting bloated, and there's a good time to be selling them, particularly selling puts if you expect that the VIX will unwind quickly to the downside, which is what oftentimes happens with the VIX. And that kind of brings us back to where we're at right now, where again we have an elevated options market where the VIX is above 30. And what you've seen throughout history is that that does not last traditionally, right? The VIX does not stay above 30 for weeks and weeks and weeks and months and months and months. Usually you have those quick pops up because there's fear in the system, and then it quickly gets unwound back to the downside. So you have to kind of act quickly, strike while the iron is hot. And I, for one, like selling puts when volatility is high. In fact, I think of the conditions that we're in right now as superior put selling conditions, which is why I sold a put in the Market Outlook video for you guys on Tuesday, and we'll be doing it yet again this afternoon, or in this evening's presentation as well. We'll get to that in just a little bit, but I just kind of wanted to kind of share that with the audience here as well. Some of you might not be putting that on your routine as far as looking at the VIX regularly and just kind of getting a sense of where do we stand right now. There's fear in the system right now, and if you're brave and you're selling puts on high quality stocks that you actually want to own at lower prices, these are optimal times in my book to be selling puts. Others may disagree, and that's okay. There's a lot of wiggle room for debate, but I, for one, am definitely pushing into the idea of selling puts with these types of VIX environments. Let's go ahead and take a look at some 12 grid analysis now. We'll look at the asset class 12 grid. This is chart 5A to get us started. Remember, the background colors will change depending upon the posture from an intermediate perspective on the market forecast technical indicator. Now, one thing stands out to me immediately, and that's this bottom rung here. Remember when I was with you on Tuesday, we had a clean sweep on that bottom rung of green charts. That is no longer the case. Gold has really fallen out of bed here since the Fed announcement. And so we were looking pretty strong on gold on Tuesday, and here we are on Thursday falling all the way back below that moving average. So I've been kind of talking about gold, although we haven't actually taken a trade on it. I've been talking about how it would have been a pretty strong idea to be selling iron condors on gold. And it was on Tuesday where I was like, well, things are changing a little bit, where maybe it's getting a little bit more directional, where a neutral trade like an iron condor might not be ideal. But here we are just a couple days later, and it's kind of the same story. Had you been selling iron condors on gold for the last 2 or 3 months, I think you would have done really well for yourself. Remember, GLD is a great product to sell iron condors on because you have dollars between your strikes in most cases, sometimes even 50 cents. We talked about that concept in my question and answer session today as well. So that is one thing that stands out to me right out of the gate, is the big move lower in gold the last 2 days. We're now back to a weekly bearish posture on GLD. You'll see here that TLT is the other thing that catches my eye. This one, I have a much bigger smile on my face about because, as you guys know, you've been following along with the trade, we have an open trade going on TLT right now, and it is a bull put spread. And a lot of people might have thought I was crazy for putting it on back here when we got these first set of oversold cluster signals. But right now, I'm here to tell you that in real time, we are making money on that trade. It may not look like the prettiest of charts, but remember, the flexibility of selling a bull put spread allows us that freedom, right? We don't need a chart that goes straight up. What we need is for a chart to stop going down effectively, right? Or at least going down in a dramatic way. We sold the 139 strikes as part of that put spread. I think we did the 139, 137, if I remember right. That will expire in February. And it's been touch and go. There's been some of these uglier moves here where we've been talking about that possibility of an inverted head and shoulders pattern. And notice how we are getting those oversold cluster signals appearing at each of those levels there as well. But today was actually a really good day for TLT. Notice it was up 1.8%. We are back to a weekly bullish posture. Now, this is not a trend, and I've always been upfront with you guys since I placed that trade. I said I would not be a buyer of TLT here, right? Because I believe that bond prices in general will head lower over the long term. But I did think of this as a unique moment in history. We're selling a put spread where we take in a credit to start that off and just make sure that the chart kind of behaves itself in the foreseeable future was worth gambling on, and so far so good on that one. But it will have a little bit of a challenge here soon enough as it approaches this falling 30-day moving average. So this story is not quite written yet. Remember, we still have another 3 weeks or so before the February contracts expire, but right now we are in pole position on that trade. You will notice that, like is often the case, when bond prices are up, bond yields are down. Today, the 10-year yield did fall just a skosh. We ended at 1.80 on the 10-year here today, but obviously still in a pretty significant uptrend there in terms of interest rates, as that's been one of the bigger market stories here lately. And we do still continue to have that strongly bullish posture with interest rates above their rising 30-day moving averages there. Notice that oil continued to work its way higher. I mentioned that concerning USO specifically, we actually talked about that in my class on Monday for the trend trading class as an ETF example of a trend trade. And we have had 3 days of bullishness since then. We are back to new multi-month highs on USO. So oil seems to be holding up really well at a time when gold is falling apart there. Remember, gold is a little bit more of a financial asset, whereas oil is a commodity that is kind of dictated by prices worldwide, and sometimes there's a little bit more pressure geopolitically and different things like that as well. But it is interesting to see the difference between gold and oil all of a sudden. They were kind of acting in unison up until the Fed meeting. Once the Fed meeting happened, particularly as soon as Jay Powell opened his mouth, gold started falling out of bed, whereas there was still continued demand for the usage of oil itself. You will see that the US dollar also is worth mentioning today. Holy mackerel, take a look at this move on UUP. I know it's maybe somewhat hard for those of you, especially watching on a cell phone, to see these miniature 12 grid charts. So here's the blown up version. Look at this move on UUP today. I mean, a couple of days ago I was saying we're at a make or break point for UUP. This is an important level because while we crossed above the 30-day moving average on Tuesday, we actually closed just a hair below it. My oh my, what a difference just 2 days make on the reserve currency of the world. Now remember, UUP is technically the US dollar versus a basket of other foreign currencies. But it is at least a good proxy for us to get a sense of what's happening with the dollar. And right now, money is flooding into the US dollar. And oftentimes that's as a result of its kind of safe haven status that we have with it. Other charts you can see are mostly red, no surprise. We are getting a breakdown on EEM. I am sad to report that those Chinese internet stocks that I was hopeful would catch a bounce here one of these days, especially Alibaba, that has fallen right back into its downtrend, sadly. Wish that wasn't the case, but you're not going to win them all. So it is what it is, but you will see that EEM, after looking like it wanted to stabilize above its rising moving average, is right back down there in the doldrums, just like the U.S. market and the foreign developed stocks. So does not look pretty there. I would also point out that preferred stocks don't look particularly good. Remember, preferred stocks, all else being equal, tend to follow the pathway of bonds themselves. They're kind of viewed as bond-like proxies, so not a surprise to see pressure on them, just like we've seen pressure on these other bond charts. But it is maybe somewhat noteworthy that things have gotten quite extreme in terms of preferred stocks, where you are actually getting oversold cluster signals on that right now as well. So it'll be interesting to see if we get a little bit of a snapback there on some of those preferred stocks. Let's take a look now at our sector 12 grid. This is chart 5C. And once again, it's only energy, and that's it, right? It's energy and everybody else. Energy has the green chart off to the right-hand side here, and they continue to be robust. It's been impressive, to say the least. We have not seen this type of resilience from any of the other sectors. I was holding out some hope a couple of days ago that the staples were going to be at least in the discussion of that conversation, but even they've kind of fallen by the wayside more recently. Notice the consumer staples now have the darker pink background, just like all the rest of the charts, and they now have a red moving average as well. So this is kind of a unique environment where we have one sector out of 11 that looks absolutely red hot. And we talked about the sector rotation model in my class on Monday. The traditional model suggests that oil is one of the last things to top out before giving way to a poor economy. Whether that's happening right here in real time or not is anybody's guess. But remember, it did play out to that degree back in 2008, 2009, when oil prices were spiking to like $150 a barrel, and then eventually it was just too much for the economy to absorb, and everything just kind of started collapsing around it. So whether we're in that type of a move right now or not is anybody's guess, but it is peculiar to see one and only one sector trending higher at the exact same time every single other sector is lower, with a strongly bearish, not just weekly, but strongly bearish posture, and all of them trading below falling 30-day moving averages. Strange indeed. So some of these are so bad it could be getting closer to good, and I might be throwing real estate into that category. Notice that real estate today did close with an oversold cluster signal. Yesterday, utilities did. Remember, sometimes those two travel in unison because of their interest rate sensitivity. So utilities put in that oversold cluster signal yesterday. They actually managed to close in the green today in response to that. So maybe, just maybe, we'll get a green day out of real estate tomorrow in response to their oversold cluster signal here today. But yeah, it was a challenging day. No surprise that discretionary was the worst performer, down 2.42% because of how big of an impact Tesla has on the discretionary shares. Remember, tomorrow you could probably expect technology to have an outperformance day as a result of what we're seeing thus far with Apple after hours. All right, let's get into our trade application example here today. This is actually one of my more favorite trade application examples I've done in some time on this video. Not to play favorites out there, but naturally you're going to like some better than others. And I really like the setup here tonight for a company I've long admired and have had some success with personally and also professionally with our dividend classes that I've taught many of you since 2014, because T. Rowe Price is a company that we have managed to pick up quite often in the past when it's approached its 3% yield area, and has continued to do quite well throughout time. Now this chart gets a little bit skewed, so my apologies for that. There's not a whole lot we can do when it comes to think scripting as a result of the way that Thinkorswim plots dividends. They do not distinguish between special dividends and normal quarterly dividends. So you see this huge jut higher in these stair-step lines here. That is because T. Rowe Price last year showered the cash upon shareholders with a $3 per share special dividend, but it does make it look a little peculiar when we're trying to just evaluate the chart at the same time. But before I kind of get rid of those dividend stair steps, I did want to at least show you that where we're at right now. So T. Rowe Price, in case you weren't aware, they reported their earnings this morning, and Wall Street didn't like what they saw. They sent the stock price down significantly. It actually ended up a couple of bucks off of its lows, but still ended up closing lower by 4.32%. That is a tough day for T. Rowe Price, ticker symbol TROW. T. Rowe Price, for those of you that aren't familiar, is a dividend aristocrat company. Remember, we talked about those on Tuesday, since they just announced the new list here within the last week. So T. Rowe Price is one of those random financials companies that people tend to forget about from a dividend perspective, because a lot of times people think about the banks when it comes to the financials, and a lot of people understand that the banks largely had to cut their dividends in 08-09. But remember, T. Rowe Price, as an asset management firm largely focused on mutual funds and other investment products, did not have to suffer the same regulatory blows back in 08-09 that the banks did. So they were able to maintain and even grow their dividends in the 08-09 crisis. So you can see that with today's give back, T. Rowe Price is now yielding 2.88%. Our average high yield line here, this blue line, where traditionally investors have been willing to start establishing longer term positions, happens usually at 2.85%. So in other words, it's already attractive at these levels. Now, you can also see that it has a dirt cheap payout ratio of only 33%. It's got a dirt cheap PE ratio of only 12 times earnings. And, it's had reasonably good success with its earnings. You can see that earnings trajectory down below here, kind of where I'm circling, quarter over quarter over quarter. It's usually going higher. It's a little bit lower here this time around, but in general, if you were to look at where we were a year ago, those earnings have been heading higher. So obviously there are always concerns with all different types of business models. In particular with T. Rowe Price, people are concerned that mutual funds are going the way of the dodo bird, and ETFs are taking over the world. And what does that mean for T. Rowe Price? And they've handled things just fine. This has been a trend that's been happening for a while, yet this is a company that continues to out-earn its potential here. Today was a rare swing and a miss from the company, but that presents opportunities for those who are willing to think longer than just 3 minutes or 3 days or 3 weeks. If you're willing to think 3 years or 3 decades, then these moments are moments where you might be willing to take advantage of high-quality merchandise. I'm going to go ahead and let's get rid of those lines here real quick, because I also wanted to point out, now that the chart is not skewed as much for that $3 special dividend, I also wanted to point out that T. Rowe Price has been falling so quickly in 2022 that it now has oversold cluster signals. Remember, we talked about that concept with the Texas Instruments trade on Tuesday as well, so this should not come as a surprise to you, but I like those situations where this thing has been beaten to a pulp to the point where you stand a good chance of finding some sort of a short-term bottom in the near term as a result. You'll notice that back here in December of 2018, remember that's what I just had identified a little bit ago when we were looking at the VIX chart, when the market was getting clobbered during that holiday season of 2018, T. Rowe Price was also getting clobbered, similar to today, right? It's natural. Remember, T. Rowe Price sells a lot of mutual funds and financial products that are directly hitched to the prospects of the stock market itself. So in a way, when you see this falling the way that it is, it makes sense, right? Their fees and their income is hitched to the asset prices of those mutual funds themselves. T. Rowe Price has really out-earned its potential to the upside compared to other well-regarded asset management companies, because T. Rowe Price has focused a bit more on the growth stock side of the equation. And of course, with growth stocks going ballistic to the upside over the years, that has benefited the T. Rowe Price mutual funds. Now we're seeing the unwind of those growth stocks, and you're seeing the opposite effect taking place. But you will see that back here, in December of 2018, you also plotted these little green dots, which are those oversold market forecast cluster signals on weekly candle charts, which are more rare than the oversold cluster signals on daily candle charts. You don't see them all that often, particularly on high quality merchandise like T. Rowe Price. And so you can see right here, back in that time period, it was yielding a little over 3%. It's just in that 3% territory, similar to approximately where we're at right now. And you will see that it was trading at about $86 back then. Had you had the ability to go back in history and scoop up some shares there, you're probably happy about that decision along the way, particularly understanding that since then, all they've done is jacked up that dividend at dramatic rates. So remember, anybody who locked in 3% yields back here now has a much higher yield on cost, meaning that your specific entry point on your cost basis yields you way more than somebody who's just buying today for the very first time at only a 2.88% yield. So that is helpful, for a long-term investor to kind of appreciate there as well. Some other information wanted to share with you on T. Rowe Price is they have raised their dividends for 35 years in a row. Again, one of those dividend aristocrat companies, an illustrious company there. So, think about all the change that's happened to society in the last 35 years. All T. Rowe Price has done behind the scenes is kept on going about its business the way that it always has and kept on plowing out higher and higher and higher amounts of dividends along the way. Their most recent dividend increase was 20%. That's another point I wanted to share with you. Going back to the chart here briefly, notice that if I were to kind of zoom in on, let's just call it the last few years, it's a little bit easier for you guys to see these yellow labels down at the bottom. Again, just disregard this 3 here because that was a $3 special dividend. But what I wanted to point out is that they've paid an $1.08 dividend for the last 4 quarters. The year before that, they paid 90 cents for 4 quarters. The year before that, they paid 76 cents for 4 quarters. The year before that, they paid 70 cents for 4 quarters. The point is, they're on a typical pattern of a lot of U.S.-based dividend payers, which suggests they are going to be raising their dividends very soon. In fact, I speculate that they will be raising their dividends before February 10th. And so I'm bringing that up now because remember, while we can only right now claim that they are yielding 2.88%, the reality of the situation is I am 95% convinced in my own head that they will be raising their dividend, and whatever that future rate will be means that today's yield is actually a bit of a mirage in a good way. It's actually much higher than what you see right here in front of you because I do expect T. Rowe Price to raise their dividend and probably do so at a reasonably good rate. Now, will it be the spectacular 20% rate that we saw last year? That would surprise me, but it wouldn't be overly surprising to see high single digits or low double digits, which basically means you are sitting on a 3% yield here currently in real time, even if you don't know it, if you were to buy the stock here today. You can also see that they've done a really good job of raising their dividends on an annualized basis. Notice that they have annualized basically a 15% annualized dividend increase over the last 5 years. And that's not 15% total in 5 years. That's each year of those 5 years averages out to about 15%. You'll also notice that a 10-year number, going back a full decade, it's equally as impressive, 13%. Notice that these numbers here fare very favorably to these numbers directly below it, which represent all 700 companies that have grown their dividends for at least 5 years in a row. So these are just really impressive numbers, especially for an aristocrat. Because all else being equal, the longer your prior history of raising the dividend, the greater the chance is that you will have slower dividend growth. But T. Rowe Price is kind of bucking that trend. We had that conversation earlier today in my Q&A class talking about Tractor Supply here today as well, raising their dividend by 77%. So anyway, things are looking really good with T. Rowe Price's generosity. Talked about the payout ratio being dirt cheap as well. 33%. Basically, a third of their profits is being paid out as dividends right now. They have plenty of capacity to grow that dividend dramatically if they so desire. They're trading at a cheap PE ratio of less than 15 times earnings. Their ROE is spectacular, particularly considering this next element. Their debt-to-equity ratio is 0.00. This company does not have any long-term debt. There are very few high-quality companies, even on the aristocrat list, that can make that claim. This is one of the only ones that I'm aware of with this long of a history that is considered a true blue-chip company that is completely debt-free. Remember, if they were leveraged to the hilt, they might be forced to pay down some of their debt, and therefore that might impact their ability to grow their dividend. But they have zero debt. They don't have any of it to pay down. They might have other growth projects or perhaps buying out some of their competition or what have you that they have plans for their money. But in general, this is yet another reason why you should expect a very robust dividend increase here within the next 2 weeks on T. Rowe Price, which enhances this situation even further. They do have a beta that's slightly over 1.0, so expect a bit more volatility out of this one. But that's not the end of the world when you're dealing with such positive other fundamental metrics that I just unveiled there for you. So let's now talk about what it is as far as the trade application example that I'm doing. And as I mentioned before, I'm selling a put on T. Rowe Price. And you can see I've kind of got some of those metrics drawn up in this spreadsheet up above here a little bit better for you to kind of absorb as well. Some of you might not be as familiar with the concept of selling puts, but it's basically a way for you to attempt to buy a high quality stock at a lower price. So you can see here the contracts that I established here today. We're looking at the March contracts. Those are the monthly contracts, the $110 strike price, and we were able to get $1.20 for that here today. Now, I did that trade a little bit early, similar to Tuesday. Those of you that were in my premium class this morning, I basically told you in advance that was the trade I was going to do. And sure enough, within about a half an hour of getting out of that class, I did just that, because you can see over here on the trade tab down below here that I did the trade at earlier today at about 12:04. Now that's my time, so that's Mountain Central or Mountain Standard Time, I should say. So at just over noon or past noon. And we were able to get filled at 120. Now at that time, there were only a couple of contracts that were traded. I can now see that many of you, after getting my Telegram message, probably also traded those contracts, and lots of them were done after me at 120. In fact, some of them were done at 125, maybe even 130, because I think I placed that trade, it would have been, you can see the time frame, about right in this general vicinity right here. That's about noon my time on the chart. And there was a further dip about a half an hour later where those of you that would have placed your trades would have gotten good fill prices on that. You then had a rally through the rest of the day, which is why we're now up $15 per share on that. But again, notice that I placed the trade at 12:04. And then when it comes to our Telegram, you can see here that we send this out to our premium members. I sent that out to you guys at 12:05. In other words, 1 minute later. So sometimes those of you that are not our premium members might wonder, how does that process work? When David and I are placing trades, we're trying to get that information out to you as quickly as possible. Sometimes we have to wait until after class, right? Because we can't do two things at once. But in general, we are trying to get this information out as quickly as possible. Not to suggest that all of our trades are going to work, but to give you that opportunity to at least evaluate the trades for yourself before everybody else that gets to watch the free video later that night. So if you're not a premium member of Market Scholars, we'd love to have you here. Make sure you check out our subscription offerings there. But with that spreadsheet I was showing you before, because we are doing the March 110, so the Marches are the contracts that are 50 days till expiration. We usually focus on that 20 to 60 day window, and I usually look for the 1% return on risk. In this case, since I got a $1.20, which was on the underlying 110 strike, that's more than 1% return on risk. So for those of you that are newer to this trade idea, I basically took in $120 for my willingness to say I'm willing to buy T. Rowe Price at 110. Heck, I'm mostly interested in buying it right here if I didn't own it already, right? But the point is, it's already attractive at these levels. Imagine if it fell from the current 150 down to 110, it'd be hugely attractive. In fact, you can see I've got this other column drawn up over here that says adjusted yield upon assignment or exercise, and you're basically talking about a 4% dividend yield if we do still have a market that is stumbling into the next couple of months, and one thing leads to another and we have a cascading market. Worst case scenario, you get put shares of an extremely high quality company that has zero debt and has very little chance of going bankrupt or anything like that. And you would lock down an original 4% yield for doing that. And remember, this is actually a low ball number because I am expecting them to raise the dividend within just a couple of weeks. And when that happens, this dividend rate will go up, and therefore this adjusted yield will also go up. So there are so many positive elements to this trade idea tonight that I can't help but to get excited for it. So anyway, I hope you learned something about that process, about how I evaluate dividend stocks, how I think about long-term investing, and how we can incorporate options trading to kind of establish our original positions at more favorable levels. If you got value out of tonight's video, I ask one simple thing out of you. Just click like for me there on Twitter. As long as we're up and over 100 likes, I'll plan on doing another full-length video for you guys on Tuesday. If we're under 100 likes, then I'll just do a quick hitter 15-minute video with no trade application example, but I'll leave that up to you guys in the end. So again, appreciate you guys checking this out. Appreciate your patience as these videos have been a little bit longer lately, as there's been a lot more things to talk about with these chaotic markets. And I hope you all have a wonderful weekend. Remember, David's technical analysis class is tomorrow, so check that out if you're a premium member. And then if you have nobody to root for this weekend, root for those Rams for me. We've had some difficulties with the 49ers in the last 6 games, so I'm hoping we can kind of get past that hump and the Rams can make their way into the Super Bowl in front of a home audience there in Los Angeles later on in February. So with that, I want to wish you all the best of success with your trades and your investments. Goodbye for now.